Chapter 13, Qualified Plans, General Rules for Qualification. True, false. 1. The ratio percentage test states the qualified plan must cover a percentage of non-highly compensated employees that is at least 70% of the percentage of highly compensated employees covered. The answer is true. 70% must be covered. Go ahead and read number 2. We'll pause. The answer to number 2 is true. The top-heavy plan is one that provides more than 60% of the aggregate accrued benefits or account balances to key employees. Let's pause and read number 3. The answer to number 3 is collective bargaining agreements. These employees do not need to be included in the evaluation of discrimination in qualified plan offerings. So number 3 is false. Let's pause and read number 4. And the answer to number 4 is false, because the top paid group of employees for a year is the group of employees in the top 20%, not 25%. Let's pause and read number 5. The answer to number 5 is defined contributions can be integrated with Social Security under the excess method, and that is true. By definition, it is only under the excess method. It cannot be used with the offset method. Only defined benefit plans may use the offset method for Social Security integration. Let's pause and read number 6. And the answer number 6 is true. Church and government qualified plans must meet special rules. Multiple choice number 1. Let's pause and read question number 1. And the answer to number 1 is there only are 2 tests, the ratio percentage test and the average benefit test. Therefore, A is the proper answer for number 1. Let's pause and read number 2. And the answer to number 2, the Internal Revenue Code section governs or regulates qualified plans, is A, section 401. And number 3, which of the following are methods for integrating defined benefit formulas for Social Security? There are only 2. The excess method and the offset method. So the answer will be 3 and 4. And number 4 asks, what is the maximum number of years of service a plan may require before a participant is 100% vested in a qualified defined benefit plan? The answer is C, 7 years. Or D, 7 years. Question number 5, a qualified plan must satisfy which of the following tests? There are 2 tests. There's the A ratio percentage test and B the average benefit test. So the answer is D, either A or B. Question 6, Social Security integration. Well, A, it does reduce the cost of offering a qualified plan. It lowers the contribution for the employer. B, allows employer to make greater contribution or benefits for highly paid employees. That is correct. C, must maintain a certain ratio of contributions to highly individuals versus highly compensated to retain permitted disparity? No, that is not what integration is. So the answer is only A and B. The answer is D. Number 7, for a defined contribution plan, annual additions include which of the following? Well, yes, they include employer contributions. Number 2, they include employee salary reductions. C, planned forfeitures, yes, they get included. And D is all of the above. E is only A and B. The answer is D. All of those items are included for a defined contribution plan addition. So the excess allowance can be no greater than, for permitted disparity in Social Security integration, the answer is the base percentage, is the maximum excess allowance. So number 9, the owner of Hilton Tours is considering installing a money purchase plan and integrating it with Social Security. Which of the following is true? Well, A, Social Security integration will allow them to make greater contributions to higher paid employees. Yes, that is the reason for permitted disparity in Social Security integration. B, Hilton's owners must use the excess method for integrating defined contribution formulas. That is true. That is the rule. C, Hilton's owner must use the offset method. That is not true. They cannot use the offset method, but must use the excess method for defining contribution plans. Therefore, the only answer that is correct is D. A and B is the correct answer. D. Number 10. Dalton Construction has a defined contribution plan that provides 65% of account balances to the 3 owners, each of whom have a 10% ownership of the company. Therefore, the company is a top-heavy company, has a top-heavy plan. So which of the following vesting schedules would they be permitted to use? They would be permitted to use C, a 3-year cliff. Note that 3 to 7 years is more beneficial to the company. That wouldn't be available. And a 5-year cliff also is more beneficial to the company, less beneficial to the employee. So the faster 3-year cliff they are permitted to use. Number 11, as an actuary, you are helping the company determine the annual cost of its defined benefit plan. In making your calculations, you must make reasonable assumptions about employee turnover rate, yes. Employee salary scale, yes. Future investment in inflation rates, well, of course. So the answer is D, all of the above. Number 12, Bankroll Corp sponsors a profit-sharing plan in which 4 employees made elective deferrals. The payroll is $500,000. Bankroll's deduction is, well, the rule is they can only deduct no more than 25% of the payroll. So 25% of $500,000 is $125,000. So answer C is correct.